Welcome back. Earlier today, Shiller home price index was released. Home prices rose for a third straight month. That's on a month-over-month basis, seasonally adjusted. Year over year, the number was down 0.2%. The biggest gains were found in Miami, Chicago, and Atlanta. We're going to take a look at some home price index charts and also an unusual situation we are with the VIX. But first, let's get to the home price charts. This shows us the statistics, the amount of days since we've seen a higher high or a lower low. And when we see a very big number, it indicates that we're sitting at the precipice of a very big breakout or breakdown. So first, take a look at the left-hand side, the home price index. We have not seen a higher high on this particular economic report in 217 days. The bigger the number, the larger the number, the more significant that new higher high will be as soon as we approach it. So make note of the large numbers here. That shows us very significant potential breakouts. The 20 city home price index also sitting at a 217-day high. All transactions house price index, that's at a 195-day high. The federal funds rate, just to give a little context, 0, meaning that we're at the highest high we've seen in quite a long time. Obviously, interest rates haven't changed in a little while. S&P 500 right below its significant high. If it makes another high, that's good for those of us that are along the market, but it's not a potential real big breakout. So it's important to note that these home price index numbers are sitting right below pretty significant highs. Graphically, this is what it looks like. The yellow line represents a home price index. The green histogram bars show us to the degree if we see a higher high, how significant that would be. And the red obviously shows us the breakdown. It's an interesting situation we're in because if we make a higher high or a lower low, a higher high than we've seen going back to late 21, early 22, or a lower low that we saw late 2022, that would represent a significant breakout or breakdown. Think of it like a stock chart that we haven't broken out to the upside or downside in quite a while. That eventual move will be a big sign. Here's a 20 city home price index. It's the same pattern as well. We see we're sitting right near 250-day highs and lows, almost 250. All transactions house price index, it's the same chart, remarkably right off the very, very significant highs. This is a home price index against the federal funds rate. Federal funds, we know they paused during the last meeting, holding interest rates steady at 5.25. The home price index sitting not too far off of its high. Now, we speak about this a lot. The Federal Reserve, its effect onto the bond market. The Federal Reserve has been raising rates aggressively since early 22. During that period of time, the home price index has risen in part due to a very inflationary environment. Now, we peaked on the home price index April, May of last year, 2022, and it has come down. But if this home price index is able to surge to new highs, what does this tell us about the Federal Reserve? They haven't raised rates enough or aggressively enough. Now, this is a quarterly number, so we're not going to get a new report for a little bit of time. But the fact of the matter is, we're all trying to guess what the Federal Reserve is going to do next. And, we spoke about the other day, the dual mandate. The Federal Reserve is trying to achieve maximum employment, stable prices, and a controlled moderation of inflation. Well, if those home prices continue to surge, that's inflationary, and that gives the Federal Reserve more reason, more cause to raise rates further. And we can forecast what those implications would be to the stock and bond markets. Here in red, we see the S&P 500. As the home price index rose, the S&P 500 started to fall. It doesn't really make sense. Home price index is reflected in part in stock prices, but the fact of the matter is the S&P 500 takes into consideration a lot more than just the home builder stocks. But the fact of the matter is, as of late, stocks have risen along with the home price index. So it'll be interesting to see which way both of these markets decide to turn. And finally, we have here the home price index is in yellow. The 1-year Treasury bond is in green. The 10-year Treasury bond is in red. We have a very much an inverted bond market. Eventually, we would think that we're going to return to some state of normalcy where the inverted bond market will end. Now, how that will transpire is really the $5,000 question. If we see, for example, the economy turn or continue to develop in a more optimistic, strong way, we would expect to see the 10-year Treasury bond yield start to rise. The red line would cross up above the 1-year Treasury, the green line. But conversely, if we expect to see a downturn in the market, maybe if the home price index begins to fall, we would expect to see the 1-year Treasury cross back below the red line, the 10-year Treasury. So eventually we do, of course, expect these lines to cross over one another again. But the real question is, does a green cross down or does a red cross up? Now, we should also talk about the VIX because we're sitting at a little bit of an unusual situation here. The red line's the S&P 500. The VIX is the volatility index. It's also known as a fear index. It essentially measures the premium on the near-term options on the S&P 500, those options that are set to expire the soonest. Now, premiums on options tend to rise when there's fear in the markets. Typically, the fear gauge indicates that the market's going down, and there's a lot of fear when it goes above 40. When the VIX is below 20, it indicates that the market is strong. There's a lot of complacency out there, and the markets tend to go up. But not so often do we see the VIX below 15. That's a very significant moment because it indicates that the market is in a very strong trend to the upside. Now, doesn't mean the market's going to turn tomorrow back to the downside. Not at all. The VIX can stay below 15 for a sustainable period of time. And, we'd advise a great deal of caution trying to bet against the market when the VIX is below 15. When the VIX is below 15, it means the stock market's very strong. And that's exactly where we are right now. This is the S&P 500. The VIX is in purple. Now, the 20 simple moving average is in red. The 90 is in yellow. There's nothing necessarily very special about these particular moving averages, only that we have a long-term and short-term. And when the market is strong, the short-term is above the long-term. What traders will do is they'll look to buy when these moving averages are we're probably closer together. And when the market, in this case the S&P 500, the white line, comes back down towards the the short-term moving average, or even the long-term moving average. I think that it's a little bit difficult for us to take a position if the moving averages are so spread apart. But the fact of the matter is, on the other side of the coin, we're at a situation VIX sub 15. That indicates that most likely the market is in a long-term trend to the upside. Take a look at 2020. The VIX, again, in purple, the white line's the S&P 500. And notice, just to give you a little bit of a historical point of view, what this means. Let's say we're looking for a trading signal where the VIX is declining and the moving averages are in order, meaning the short term, the 20, is above the 90, the long term. Well, that crossover took place, let's say June, July of 2020. The S&P 500 at that time was around 3,000, roughly. The VIX at that time was around 28. Now, again, remember, VIX sub 20 is really the picture that we're looking for. Well, the VIX came down to level around 21 August 2020. It didn't drop down below 20. 21 in December 23 in December of 2020. During that period of time, and this is an important thing to make note of, the S&P 500 went from 3,000 to 3,600. What's that, around 20% increase, if my math is correct? The S&P 500 goes up around 20% in 7 months. We would hope the stock market goes up 20% in a year. In 7 months. And that was all during a period of time that the VIX was still above 20. 21, 25, even up to the 40 level. Didn't cross above 40, but 25 to 40, and the market goes up 20, let's say about 20%. And during that period of time, traders looking to buy near the 20 simple moving average. You buy here, you take profits as it goes up, or you buy near the long-term moving average. There's no special recipe for moving averages, but I think it does help define what type of trend we're in. And, very clearly, it's in the long-term trend to the upside at this point. So these are the most common VIX levels going back 8 years or so. How many days did we find the VIX at a particular level? Well, the VIX, and this goes back 8 years, but keep in mind, the past 8 years, for the most part, have been quite strong markets. Well, 33% of the time, the VIX was a level between 10 to 15. Between 15 to 20, another 28%. Between 20 to 25, another 18%. So we're talking 32, about 60% of the time, the VIX was anywhere between 10 to 25. It's very rare that we see the VIX above that level. So these are common levels, to be sure, over the past 8 years. But aside from that COVID crash, we've seen actually pretty strong markets, with the exception of last year, of course. Now, below we see the x-axis shows us the VIX levels, VIX 10, VIX 15, etc. These histogram bars indicate the average return we can expect. Take a look at the green lines. That's the average 90-day return. So imagine we just, pull up the stock charts and say, okay, we see the VIX is at 20 right now, 20 to 25 in that bracket. Well, historically speaking, when the VIX is between 20 to 25, we can expect the S&P 500 over the next 90 days, over the next quarter of a year, to only go up 4%. Well, if you annualize that and you say, okay, well, 4% every 90 days is around 12% for the year, I think that's actually what we do expect historically. But those aren't really great returns. The point being is that when we see a VIX at 20, it means the market is already very, very strong. When we see the market or the VIX at a level of 25 to 30, every 90 days we expect, historically speaking, only around a 5% return or a 20% return on your money. If you're looking for superior returns in the stock market, if you want to buy the stock market and say, historically, what can I expect over the next 90 days? Well, then we want to look at a VIX 40. Because over the next 90 days, when the VIX is between 40 and 45, it means historically that we would see 18% return on your money in 90 days, or around 72% for the year. If you could buy the stock market for an entire year, only when the VIX is at 40 to 45, we'd expect around 72%. Well, if the VIX is at 40, it means the market's already gone down a lot. Take a look back at 2020. This is the VIX, the purple line here, okay? The VIX hit a level of 83, March 16th, 2020. That was at the bottom of that COVID crash. Well, how did the stock market perform over the next 90 days? Well, if you bought the stock market, the S&P 500, March 23rd, that was at 2237 S&P 500. Well, go forward 90 days, April, May, June. June 23rd, roughly, we saw the S&P 500 around 3,200. From 2,200 to 3,200. That's almost 40% roughly, 40% return on investment. So when you want to buy the stock market is when the VIX is up a lot. Well, this tells us two different stories here. First, we said the VIX is below 15. That means the market's very strong. That's true. But we also said that if you buy the market when the VIX is at 15, well, then we can't really expect very much. That's also true. The point being is that we're in a trending situation right now where the VIX is low and the stock market's trending higher. Takeaway number one, we can expect, do not be surprised to see the stock market go up higher. However, historically, we don't really expect tremendous results. If you want tremendous results, you got to wait for the market to go down. You got to wait for the VIX to go above 40. So it really comes down to whether we want to apply a trend following strategy or a contrarian buy low, sell high type of strategy. Now's the time for trend following, but be very careful. If the VIX starts to go up, if it crosses back above 20, that may be a warning sign, to get out of our trades. This is the weekly point change in the VIX. If you were to ask, well, the VIX is around 15 right now. How much can I expect? How can I expect the market to behave if the VIX jumps up or jumps back down? Well, let's say the VIX goes up by 3 points. We historically expect the market to only go up around 2.5% over the next 90 days. To summarize, if we're looking for the superior returns, we want to wait for a situation where the VIX goes up at least 10 points in 1 week. So the VIX is 25 right now, at 15 right now. If we log on to onto our trading apps next week, we see VIX 25. That means the market has probably gone down a lot. Maybe we should look to buy low. Now, of course, you can't base a trade solely on this, but that's what we're looking for. But point being is that we see very little movement. The VIX goes up 1 point, down 1 point. Very complacent market. Don't expect huge returns from this point. And this is, by the way, this is what our week looks like right now. Currently, we're at a VIX 14. Very, very low. Now, again, it can go up more. I see the S&P 500, the red line goes down a little, the VIX goes up a little. We can expect the market to continue higher, but don't expect tremendous returns. So with that said, the home price index news really didn't move the market a lot. We have earnings being released as well. So there's a lot of cross currents. The bond market's been kind of quiet these days too. So, the complacency, it can be our friend for slow uptrending markets, but just be cautious that if we start to see volatility return, if we start to see the VIX go up 5-10 points, that could be a sign of something to come. But that's not the case yet. We hope this has been helpful. We look forward to seeing you back soon.